Our YouTube presentation involves charitable contributions and the implications of FAS 109. We are Section 2, Group 9, consisting of Nate Ogden, Lauren Atkins, Brooke Watson, and Jason Howell. In our presentation, we will discuss charitable contributions and how they create three types of book-to-tax differences. First, no differences, then permanent differences, and finally temporary differences. We will also discuss reporting requirements for both financial and tax. In our first example, Corporation A gives $10,000 in cash to a qualified charitable organization. Corporation A had $150,000 of charitable contribution modified taxable income, which is taxable income before deducting charitable contributions, the DRD, DMD, and NOL and capital loss carrybacks. For financial reporting purposes, we'll have a debit to the contribution expense of $10,000 and a credit to cash for $10,000. For tax purposes, because the $10,000 contribution is less than 10% of $150,000, all of the $10,000 is tax deductible. There is no book-to-tax difference to account for. Moving on to the permanent differences, we have an example of a corporation that donates $10,000 in cash to a non-qualified charitable organization. Because the $10,000 is given to a non-qualified organization, you are able to deduct the charitable contribution on your books as an expense, but you are not able to take a deduction for tax. Thus, you will create an unfavorable permanent income tax difference of $10,000, because you will never be able to deduct the donation for tax purposes. In our next example, we're donating an asset with an original cost of $15,000 to a qualified organization with a fair market value of $10,000. The tax basis in the asset is $5,000 because of accelerated depreciation, but $10,000 for financial. This difference of $5,000 creates a $1,750 deferred tax liability, which is calculated by taking the $5,000 and multiplying it by our assumed tax rate of 35%. For financial purposes, we're able to deduct the full book value of the asset for the charitable contribution expense, and then we also reverse our deferred tax liability at the end of the year. This creates an expense of $10,000 for charitable contributions and also a $1,750 income tax benefit. For tax, Corporation A deducts $5,000 for the tax basis, creating a $5,000 unfavorable permanent tax difference. This next example has the same facts as before, except now the equipment that they donate has a fair market value of $15,000. In this scenario, the financial implications are that you can deduct the fair market value of the asset on your books as a charitable contribution, but you also have to recognize a gain of $5,000, which is the difference between the fair market value of the donated asset and the book value. We would also once again reverse the $1,750 deferred tax liability. The tax implications are that we can take a $15,000 deduction because it is capital gain. This kind of charitable contribution is efficient because the fair market value of the property can be deducted, but they are not required to include the appreciation of the asset in taxable gross income. Therefore, you have a permanent favorable difference of $5,000 because for financial purposes, you are able to expense the $15,000 of charitable expenses, but it is also offset by the $5,000 gain. So for financial, you in effect have a $10,000 expense, but for tax, you have a $15,000 deduction. Along with permanent differences, temporary differences between tax and book income may arise. Temporary differences arise when there is a difference between the tax and financial basis of an asset or a liability. Anytime we reduce book income, we are creating a favorable difference. These occur when we are deferring revenues or accelerating deductions. These differences are also called taxable differences because at some point this income still needs to be taxed. These differences create deferred tax liabilities. An unfavorable difference occurs anytime we increase book income in the current year. These arise when we recognize additional income or defer deductions. These differences are also called deductible differences because this income has already been taxed and will not be taxed again in the future. These differences create deferred tax assets. In dealing with charitable contributions, there are two main reasons a temporary difference would come up. Tax law states that charitable contributions are limited to 10% of an individual's charitable contribution limit, modified taxable income, as was stated earlier in this presentation. The excess contribution over this limit can be carried forward for 5 years and can be used when there is taxable income to use against the carried forward deduction. When it is deferred, it will create a deferred tax asset because we are putting off a deduction. The tax law also allows for a deduction of charitable contributions before the contribution is made. Taxpayers can take this deduction when A. the contribution is approved by the Board of Directors, and B. the contribution is paid within 2.5 months after year end. Let's look at an example of these temporary differences. Corporation A has charitable contribution modified taxable income of $100,000. They contributed cash of $15,000. How do we account for this on the books of Corporation A? When we make the donation, we recognize a contribution expense for the entire amount of $15,000 since there is no limit. And then we make a credit to cash because that's what the corporation donated. Under tax law, the maximum deduction that can be taken is 10% of the modified taxable income. In this case, the maximum deduction that can be taken in this year is $10,000. This will reduce taxable income by $10,000. If we were to assume a tax rate of 35% and no other implications, this would create a reduction in the tax expense of $3,500. Now that we have discussed the financial and tax implications, let's discuss how we will account for income taxes. On the financial books, Corporation A reduces book income by $15,000. For tax, they reduce taxable income by only $10,000. This creates a $5,000 difference. This amount can be carried forward for 5 years to be used against future income. Because taxable income includes this additional $5,000, this is considered an unfavorable difference. Because the company is including an additional $5,000 in taxable income this year, they will pay taxes on this amount this year, creating a deferred tax asset and deferred tax benefit that can be used in the future to offset future tax expenses. Assuming a future tax rate of 35%, this $5,000 deduction carry forward will create a deferred tax asset of $1,750. To record the deferred benefit, we will make a journal entry that will increase the deferred tax asset account by $1,750 as well as the income tax benefit by $1,750. This additional $1,750 asset will be taken off the books when the $5,000 carry forward is used against future taxable income. When that happens, a reversal of this entry will be necessary. Let's look at another example. Corporation J wants to make a contribution to a charity in 2011. Corporation J's Board of Directors approved the contribution in 2010 so that it could be made in 2011. The contribution will be made in February of 2011. First, let's look at the implications on Corporation J's financials. In 2010, because the donation hasn't been made yet, there will be no journal entry. In 2011, the donation is actually made. Contribution expense will increase by the amount of the contribution, $10,000, and cash will decrease by that same amount. Now let's look at the tax implications. Because the contribution was approved ahead of time, and the actual contribution will be made within 2.5 months of year end, Corporation J will be able to deduct the full $10,000 in 2010. Because J takes a deduction in 2010, in 2011 there will be no effect on the taxable income. In 2010, because on the financial books we had no expense, and for tax purposes we took a $10,000 deduction, a $10,000 taxable temporary difference was created. This difference will be reversed when the $10,000 is recognized on the financial books. So in 2010, assuming a future tax rate of 35%, this book-to-tax difference will create a deferred tax liability of $3,500. Because we are recognizing $10,000 less in our taxable income than in our financial income, in the future, this income will need to be recognized in taxable income and will be a tax expense of $3,500, creating the need to recognize this deferred expense and liability. In 2011, Corporation J will recognize the $10,000 expense on the financial books, and this will be included in taxable income in 2011. Therefore, in 2011, the deferred tax liability will be reversed, as the corporation will now be paying the tax on this $10,000 of income. We account for this reversal by reversing the previous entry and bringing the balance of the deferred tax liability back to its previous balance. The following is a list of references that we have used as we have accumulated information for our presentation.